Welcome
Welcome.
to another episode of Gentle Power. And today we are very excited to have Omeed Tabiei joining us. And it almost feels very random how we have Omeed on our podcast. Omeed, I think you and I just connected on LinkedIn, and I saw your profile. Your LinkedIn background banners is your podcast logo and brand. And I said, "Oh, Omeed, you have a podcast? What's it about?" We just started DMing on LinkedIn, and I told Omeed that we have a podcast. And I said, you should join us. And that was, I think, maybe just a week ago. So these things move very quickly, but we're really glad to have you joining us today.
Welcome.
Thank you so much. I'm glad to be here. Yeah. Random, but awesome. And as mentioned before, I love talking all things negotiation. So when you invited me onto the podcast, I was like, yeah, talk about negotiations for an hour. I'm in. Say no more.
Okay, great. That's awesome. You know you have an edge on something when you love doing it. That's the only real edge we truly have. Can you tell us a bit about your background? Maybe start more broadly and then where you're at now and why.
Yeah. So, well, real quick on the point of loving negotiations, in terms of background, when I was growing up, my dad made me negotiate for everything. So anything I ever wanted, he would always make me negotiate. My parents are Middle Eastern, and in the Middle East, you know, they have these open air markets called bazaars. And when you go to the bazaar, everything is negotiable. Haggling is, you know, like a superpower of a lot of these countries that have these open air bazaars. And he used to work in the bazaar as a boy. So he like grew up in that kind of like hard negotiating environment. So that's a little bit of background about how I developed my love of negotiating. And it was actually quite embarrassing because even growing up, my dad took this approach of negotiating and brought it to a place like America where, you know, like people don't really negotiate for things here. You can't imagine. You can't imagine like going to the store, like a supermarket, and being like, hey, you know, this thing is $5, I'll give you $3.50 sort of thing. But that very much was my dad.
I've done that. I've done that too.
So yeah, I mean, in terms of background, I've been an attorney for 10 years.
What kind of attorney?
Yeah, I'm a corporate attorney, so I do all things contracts. I help startup founders from incorporation to exit. So when they want to start their business, I help them with the founding of their business. If they want to raise capital, I help them with raising capital. And then when they want to exit, I help them with the exit process. Started my career at a company called Hyperloop. It was a super fast train that could take you from LA to San Francisco in 30 minutes.
I remember.
Did it work?
Or is it still going? What's the...
Your facial expression is bold.
Yeah, it is no longer around. I think they shut down in 2022, and it was a moonshot idea, and it was actually very feasible. It's an idea that's actually come around quite a few times throughout the years. I think the first time that it ever emerged was in something called the World Fair in the early 1900s. So it's based off of, if you've ever been to the bank, there's that tube that they send the little pipe like up through the tube.
Yeah.
So it's based off of that idea. So the concept has been around for a long time, but no, that specific company was not able to make the technology real, or was not able to, you know, build it into an actual transportation technology. But that's where I started my career. I helped them raise over $100 million as counsel on the team, grow from 60 employees to over 300. It was a really cool experience.
I'm trying to remember. Was Elon involved with that?
Elon, so there were quite a few Hyperloop companies, and the company that I was at, Elon was involved in the initial ideation of the company, and then Richard Branson got involved at one point as well. He was the chairman of the board. So yeah, it's an interesting history of what happened there that it's probably a conversation for another time.
Yeah, for sure.
Whole nother episode. We'll have you back on the pod.
Cool.
For that. So you started your career at Hyperloop.
Yeah, and then have worked in-house I worked at a hardware company. We sold high-end cameras to Hollywood studios. That sold to private equity for over $300 million. I went and I worked at a boutique law firm. We worked with Plug and Play, 500 startups, Draper University, all the major startup accelerators. Then I worked at a large law firm, and then I started my own law firm. Oh, and in between that time period, I also started 2 software companies of my own as well. So, yeah.
You just fit in there.
Just casually.
So,
what happened to those companies?
So the first company, we started in 2016, 2017, and it was a computer vision AI company. And
wow, so early.
yeah, it was like in the early days of AI. So the technology, in terms of the tech team, we weren't able to make it feasible, to make it profitable so that it made sense for us to continue running it. So that company I ended up closing that company and going in a different direction. And then I started another company that was a marketplace for holistic healers, like meditation teachers and energy healers and that sort of thing. Actually had a big co-founder dispute there, and that co-founder dispute kind of ruined my experience with that company. And so eventually I got to the point where I was like, you know what, I should just go back to being a lawyer. That's what I know best. And that was essentially how my law firm was born.
Oh, that's very cool. So right now you have your own law firm, basically. Mm-hmm. Okay, awesome. Do you have co-founders now?
No, I actually don't have any. I had a partner, but we actually again decided to go our separate ways last year. And this was someone that I'd known for a long time, and we just weren't able to see eye to eye in terms of, the way that we wanted to run our firm, so we decided to go in different directions.
Yeah, I wouldn't want to be a co-founder against you as a lawyer and we're disputing something. Okay, cool. So you have your law firm, and I think you mentioned it specializes in B2B SaaS solutions?
Yeah, we work mostly with SaaS founders and startups, software companies. That is our area of focus. Mm-hmm.
So what, in your work, when you work with these SaaS founders, how do negotiations come up? Are you helping them sell their companies to buyers? Are you helping them negotiate with investors through fundraising? What kind of situations do you face?
And I want to add to that, what negotiations do you help them with? But also, at what points do you negotiate with them? I imagine maybe your fees or anything like that.
Oh, yeah. I mean, I actually take the approach in life that everything is a negotiation. And so, yeah, I mean, the negotiation actually starts from the moment you start interacting with another human being, I think.
Copy what we said.
We are super aligned in that, because that's a very big principle that we're always very close to.
Yeah, for sure. There's different levels of negotiation that essentially happen. The first place where negotiation happens is when the client approaches me and we're deciding whether to work together or not. So negotiation of scope, negotiation of fees, negotiation of the relationship, negotiation of how the dynamic of the relationship is going to work, what the boundaries are, for example. Mm-hmm. From there, depending on the stage of the founder, it could be that we're helping them to negotiate in the incorporation of their company, for example. If there's a co-founder, we're helping them navigate that co-founder relationship. We're helping them to navigate their vendor relationships if they're using outside technical support, for example. So there are a lot of negotiations that are happening even at the beginning, and then of course, raising capital, for example, or as they're continuing to grow their company and they're, bringing on additional employees or consultants. And then of course, at the time of exit, there is, the exit negotiations with the broker, bringing on the broker, with the potential acquirers.
Yeah.
That's pretty much all the life cycle of negotiations.
Totally. Thank you for walking us through that. Does anything change in your approach when they come to you, maybe through referrals, or if you are doing outbound? Do you do outbound? How do you get
Yeah, so a lot of like in-person, especially now that I've moved to the Bay Area, a lot of in-person networking,
Yeah.
a lot of time spent on LinkedIn. I think what's really been working for me though is webinars. I really love webinars. I found that that's working super well. But yeah, of course the approach shifts based on the nature of the relationship with the person that I'm interacting with. So if they come in as a referral, there's already like a high degree of trust. They've been usually referred by someone that they significantly trust. They've identified what the thing is that they need help with. They've already been told, hey, go talk to this person. They can help you, as opposed to, you know, someone that might just stumble on my LinkedIn page and say, oh, you know, his bio says he's the coolest lawyer ever, so I'm going to schedule a meeting with him. So that's very different places in the relationship cycle.
So what does that look like on your end when you start exploring working together? What changes in your approach if they are a warm intro versus more either they found you randomly or you reached out to them cold? What does that look like? And then also I'm curious about your pricing and your offering. So I fully agree with you that there's so much to negotiate. There's so much on the table, like scope and timeline and all that. Do you anchor them with maybe a few options and then you see, you know, where you land, or is it already like a blank slate and let's discuss from scratch?
I've actually noticed that one thing that startup founders really hate, especially, I think it's very lawyer specific. People hate paying lawyers. Like, that's just a fact.
I mean, you guys are expensive.
We're expensive. I've had one of my clients refer to us as very expensive therapists. So, and not only that, I think a lot of people have had the experience with lawyers of bringing on a lawyer, and it's not that the lawyer hasn't provided value, but the amount that the person has had to pay for that value has spiraled out of control. For example, where there's hourly billing. We essentially have made our services into packages that we offer so that the startup founder knows when they come and work with us, you know, this is what they're going to get, this is how much exactly they're going to pay. And so there's a little bit of comfort that is provided to the startup founder in terms of like pricing and what to expect to ensure that their experience working with us matches their like expectation in terms of the value that they're going to receive and also the price that they're going to pay for that value. That's the first thing to answer your question in terms of, yeah, our pricing is standardized. It's put into packages. I've done this enough times where I know, okay, you're at this stage, this is what you need. You're at this stage, this is what you're going to need. And then I try to make, you know, even things that are outside of the package, for example, if you're negotiating like a big vendor contract or, you know, a big customer contract, for example, I'll say, hey, send me the contract, and then I'll quote you a flat fee based on my experience of negotiating 100 other contracts that are similar to that as well. And I think that's worked really well. Obviously, like if someone comes to you and they're a cold outreach, the number one focus is going to be moving that person from a cold outreach to a warm connection, and also remembering in that negotiation of moving that person from cold to warm. You know, a lot of times cold prospects are window shopping or price shopping. And so there are certain techniques and tactics that you can use to essentially like disarm or really get into the mind state of where that person is and how they're thinking about things to address essentially the underlying motivations and desires of that potential prospect.
What are some of those tactics that you use to bring them from cold to warm? And also our audience, a lot of job seekers, but we also have a lot of small business owners who listen to this. So I think
executives negotiating
various contracts for their company or for their team or whatnot, in self-interest for us as well. We are often speaking with people who are warm leads, but also people who are completely cold, who found us on LinkedIn or heard us on a podcast. So in your experience, what are some 1 to 2 things that you do to make someone from a cold lead to nurturing them to be a bit more warm and to consider working with you?
Yeah. Well, okay, so a few different things. The first thing that I would focus on is really understanding the person in front of you. I think that's key and core to any negotiation, is who is this person, and what can you notice about them in terms of their disposition. Are they cold towards you? Are they warm? How much information are they providing? How easy is it to get information from them? Starting to read the personality of the person across the room, across the table from you, I think is incredibly important. Connecting to what drove that person to come see you, what was the impetus that led to them scheduling the call with you? How long have they been, considering whatever it is that has motivated them to come speak to you? How painful is the problem? What is the problem? How do they think about the problem? What do they see the potential solution? You really want to connect as deeply as possible. And I think in any negotiation, the motivation of that negotiation is understanding. I think that should be the primary driver of any negotiation. Yeah. What can I understand? What can I this kind of sounds bad, but what can I extract from this person? I think in a negotiation, the most valuable asset in the negotiation is information. And oftentimes in a negotiation, the first thing that I look for is how openly does the person across the table share that information.
Interesting.
Because if a person isn't openly sharing that information, it usually means they're hostile, or even in that hostility, it could be that their seriousness about the deal making might be lacking, for example. But that also is information in terms of whether that person is sharing information or not. So I think the first thing that needs to happen is there needs to be a connection of understanding to the person across the table from you. So that's the first point that I would say is incredibly important. The second thing is, Alex Hormozy talks about this, and he got it from the book, I think it's Robert Cialdini's Influence. Yeah. And so if a person comes to you, when a person comes to me, one of the things that I try to do is, once I've connected with the problem that the person has, I'll demonstrate that I am the person that can solve that problem, that I have, the chops, that I have the experience, that I have the tools, that I have the techniques to solve that problem. But then I'll also want to give them something. And in that giving them something, usually for me, it's a guide of some sort. Hey, I've put together this guide. It actually specifically addresses, what you're trying to do. I have this guide to selling businesses. As part of that guide, what we'll give you is a number of different negotiation techniques, for example. I'm totally just making this up. Or for a buyer of a business, for example, hey, I have this guide. This is actually something that I do have. I'll give.
Yeah, what do you ask? What do you give them?
Yeah, so I'll give them a guide. It's an incredibly detailed guide. It's 13 pages long, but it also has, as part of that guide, it'll have a template letter of intent, which they're going to hire a lawyer to draft, and they're going to have to pay that lawyer $500 to $1,000 to draft that LOI. I'll give them the LOI that we use. I'll be like, here, you can have it. It's an ironclad LOI. If you hire us, this is literally what we're going to use. That's the first step in the process that they're going to go through. And then I'll give them a due diligence request list, which is usually after the LOI is signed. The next thing that they're going to have to issue is the due diligence request list to the seller. So I literally give them the second step in the process as well. And then I also give them a closing checklist, which essentially walks them through everything that they're going to need to actually close the transaction. Now, I've essentially given them our everything except, the primary document in the deal, which is the purchase agreement. But I've got them far into the deal in terms of the guides that I've given them. And now that I've given them something incredibly valuable, if the close doesn't happen right on that call, what I'll usually work to do is I'll try to stay at the negotiating table as well. So like, okay, cool. Hey, you need to think about it. All right, so I follow up and I'm like, how's the deal going? What's been going on? Okay, so this has happened between you and the seller. Or this has happened between you and the buyer. Okay, so they said this. This is what you need to think about. So staying at the negotiating table is also incredibly important, and continuing to provide value after the fact if the close doesn't happen on the initial call. So I'd say those are the three most important things.
Yeah, I really like your approach where the guide that you send, it's almost like they've already started working with you. And I wonder if there's some sort of subconscious bias like, okay, well, we're already working together, so we may as well just, close.
It's almost like a positive slippery slope.
Yeah.
Foot in the door. And then some concept of, I'm sure, some sort of reciprocity where you give them something for free, they kind of owe you now.
Yeah. Oh, I think there's a fourth thing that I think is really important that I've learned, which is conviction. Conviction is incredibly important. And what that looks like in the context of a small business owner is actually, first of all, like being convicted about working with the person. Hey, I really would love to work with you. I know that I can help you with this. And like, I want to be the person to help you with this. So let's work together. Let's do it. Like, I am here to help you. I think a lot of people really lack that conviction in terms of they don't come out strong enough in terms of, showing an actual desire and passion to work with the client.
Yeah, got it. That's a great one. I want to go back to when you said that you offer a flat fee to help them negotiate vendor contracts. Mm-hmm. I'm curious why you went with a flat as opposed to a success fee, which might have more upside for you and might feel safer for them as well. And if you don't get them the desired results, they might be like
resentful or something.
Yeah, like they paid for nothing kind of thing. Like, how did you think about that?
Yeah, I mean, at the end of the day, we run a business, so, being compensated for our time, that's the first thing. The second thing is like a success fee in the context of like transactions for lawyers isn't typical. Typically where you find success fees, which are called contingency fees in the world of lawyers, are personal injury matters or employment litigation matters. So for example, if like you've been injured in an accident, you hire a lawyer, for example, a car accident, and they'll help you win a certain amount of money, and then they'll usually take a very large percentage chunk of that money. And the contingency fee works in that respect because the lawyer is creating value that didn't exist before. For example, they go and they win you $100,000 for your accident. Well, that's $100,000 that you weren't going to get before. So the thought process is, okay, I'll take 30% of that 100K. In this instance, the vendor contract, okay, sure, we're creating value in that maybe the estimated value of the vendor contract, for example, if you are hiring, depending on whether you're hiring a vendor or you are the vendor being hired, if you're hiring the vendor, you're going to have to pay that value for the value of the contract. So in that respect, there isn't really value being created that we could say, okay, we're going to take a percentage of that value. If it is a customer contract, even that, it's like, I don't think it would feel that good for the customer if they, were going to, close a potential customer, for example, and the annual revenue from that contract is $100,000. The profit that they're going to make, maybe $20,000 to $30,000 if they're lucky, for example, and then we're like, oh yeah, and then we're going to take 30% of the 100 for it. So I think based on those things, essentially, at the end of the day, we have to keep in mind that we are a business and there is value being translated even where the deal might not close, because usually if the deal doesn't close, it's because something has come up throughout the life of the deal that we actually helped navigate to the point where something has been identified that makes the transaction not feasible. Usually no fault of our own. It either is that the person that they're negotiating with has been identified as someone that isn't a good person to enter into a deal with for whatever reason, or it could be that the other party has decided to pull out of the deal. Either way, we've helped to navigate that transaction to that place, and we have spent time doing it as well. And the flat fee helps protect against, sometimes some deals are relatively straightforward, they go right through, that's great. But if it ends up taking significantly more time than expected, the flat fee protects the client from the fees spiraling out of control in that respect as well.
Yeah. Thank you for that.
Yeah. So when you are working with your clients, or maybe you just see this in your line of work, what are some very common mistakes that people make on negotiation? So let's say a founder is either trying to sell their business, or they're trying to renegotiate a vendor contract. Whatever situations that you see, what are some very common universal mistakes?
Yeah, so let's go with the selling of the business. Yeah. So some of the universal mistakes that I see founders make when going to sell their business is, the first one is, this is typically how founders decide that they're going to sell their business. They've been running their business. They get an email from an acquirer. It might be a strategic acquirer. It might be, a private equity firm. And that email says something along the lines of, hey, we've been watching your business for quite some time. You're very successful. We'd love to buy your business. Here is an initial offer that we've been offering other companies similarly situated than you. Let's just go up with some arbitrary number, $100 million. Startup founder gets that email. They get super excited. They're like, oh, this company wants to buy my company for $100 million. And then they enter into a process with that acquirer. Now, they've just made a fundamental mistake. What they should do when they get that email, if they are serious about selling, is, first of all, they should identify what their exit number is. So is it 100 million? Is it 30 million? What is it that they're willing to, the lowest number that they're willing to, walk away with in terms of selling their business? What is the floor of what they're willing to sell their business at? And then what is, the target valuation that they would like to achieve? Based on those two numbers, they should go hire a broker or an investment banker to run a process, because when they go into a process with a single acquirer, they're actually giving up a significant amount of their leverage.
When you say run a process, what does that look like due diligence? Does it look like shopping it around? Anything else?
Yeah. So what I mean by run a process is, when they go hire a broker, the broker is going to run a competitive process in terms of taking that business to market and identifying multiple buyers. So even before they get to due diligence, what I'm talking about is maintaining their leverage in terms of offer price, in terms of who the buyer is, because as soon as you jump into a deal with one acquirer, you've actually lost a significant amount of your leverage. Because here's what happens. I'll tell you what happens, and I'll paint an even clearer picture for you. They get this email from the acquirer. Let's say they don't run a process with a broker. Let's say they get super excited. They're like, oh, I don't need a broker. I have, this acquirer. Well, private equity firms and strategic acquirers have entire teams that are dedicated towards acquisition. So they're very familiar with these processes. And compare and contrast that to a founder who probably has never sold a business before, or maybe has sold a business. It's give up leverage right from the beginning. So they get too fixated on one buyer, and they essentially give up everything to that buyer. And then once the buyer pulls out, they have nothing on the other side. So they essentially have given up all their leverage right off the bat. Because if they ran a competitive process, they could essentially pit the buyers against each other. So that's one of the first big mistakes that founders make when they go to sell their business.
And how does the buyer know, the one that came in with a proposal, that they're the only one? I guess they could simply ask, or it's also clear you can deduce from how the founders are behaving.
It's both. So yeah, of course, I think, any person who's like in a negotiation should ask, like, are there any offers? But also you'll be able to tell. You send the LOI, the founder doesn't sign the LOI for, a week or a week and a half, for example, or 2 weeks. The buyer's going to be following up. Maybe the founder doesn't respond, for example. I think that's bad form, because an M&A process is all about relationship. And so, these sorts of behaviors will put pressure or stress on the relationship and break down trust between the parties. But yeah, I think you'll either be able to tell, or the buyer will ask, or, the seller will say, hey, we're, considering other buyers. But at some point, the buyer will for sure know either they're the only one in the process or there are other buyers.
Yeah, for sure. And so I'm curious, because we're actually working with someone right now who's selling their company, and there is a lot of market data out there on potential price, like a multiple on the EBITDA and all the various formulas. What have you seen? How much can a negotiation move the needle beyond the market data? Like, how much of where you land on selling a company is math and market dynamics versus like the negotiation kind of more behavioral science strategies, communication, relationship, all that?
I think that once valuation has been identified by the buyer, there isn't really that much wiggle room. It doesn't matter how much data you're going to be able to present to the buyer in terms of what the market is going to pay. If the buyer has already named their price, you're not going to be able to move the buyer off of. The buyer's not all of a sudden going to be like, oh yeah, you've shown me this, this data of 3 other companies that have sold, for $5 million more than what we're offering. So you know what? But what will move the buyer is, hey, we have this other buyer. They're actually willing to pay $5 million more. Either you pony up another $5 million, or we're going with this other buyer.
Yeah, for sure. This is exactly what we tell our clients too.
Yeah, especially we have a lot of clients who are job searching, and we help them negotiate their offers. So we often tell them the best leverage they can have is having other offers, and they work that into their conversation. Because if a company knows that they are our client's only option or a job seeker's only option, then they don't really have much more. They don't have reason to give them any more. They're like, well, what's your other option? Just to not have a job, right?
Exactly.
And we're working with a B2B SaaS company as well who's trying to sell, and they're like, I don't have time to shop it around. We don't want to lock ourselves into any contract with M&A firms and things like that. And that's so important if you want to sell at a certain amount and not and gain some leverage, not lose leverage.
Totally.
Agreed. Go ahead. You were about to say something?
Well, I was going to tell you the second mistake that founders often make when selling their companies. So as I mentioned, these buyers have a lot of experience acquiring companies. So even where, let's take the $100 million example. The founder, let's say the founder has identified the buyer there, and they've actually even run a competitive process. And what sometimes happens is the $100 million purchase price isn't the cash that's going to be delivered at closing. So the way that it actually might be structured is okay, $100 million purchase price, 25 million of that is going to be delivered in stock. 25 million of another 25 million might be a breakdown between what's called a holdback, which is essentially, hey, we're going to take a portion of the purchase price and we're going to essentially put it into escrow for the next 24 months. If you lose any customers, if you get sued, if there's any sort of lawsuits, or if there's anything that doesn't match up in terms of what you told us during the transaction, or during the contemplation of the transaction, we're going to deduct it from this amount that we put in escrow. So these private equity firms will put a really attractive number out, but that isn't necessarily going to be what the founder gets at close. Oh, and not to mention like working capital adjustments as well. So that's like another tactic that a lot of founders need to be aware of in terms of the offered purchase price doesn't mean that that's going to be what you actually get at close. And not to even mention like taking into account taxes, right? In terms of like the purchase price that you get is Uncle Sam is going to come and take his share as well. So
very cool. So when you get an offer, there's a bit of a dance, and there's a bit of, you have to give some information, and then you go to do due diligence. I know a lot of companies get screwed over by companies that present as interested buyers, but they don't. They're just there to market research and all that. Like, how do you advise people protect their leverage or handle such a delicate situation?
Yeah, I love that question because I literally have this conversation like so many times. And I'm glad that you're aware, because so many startup founders are not aware. Enterprise will come and talk to them and say, oh yeah, hey, we'll invest in you, or maybe we'll acquire you, for example. And the startup founder is like, here's my whole life. Look at everything. Here's my code base. Here's my operations. And I'm like, what are you doing? No. So the way to approach this, and this is what I advise all the startup founders, is you have to follow, there's a process for everything. Okay, so you have to follow a process. The process is the other party indicates an interest in investing or acquiring or whatever it is. Okay, in the early stages, there's a lot of excitement. And usually the enterprise, it's not that they're maybe disingenuous. Maybe they're serious. They really actually are contemplating a transaction with you. So there's a lot of excitement and there's like a feeling of trust and relationship, but the founder needs to keep in mind that in the early stages, you should not be revealing any proprietary information. What you should actually be doing is driving the excitement and creating more trust and connection. Yeah. And then what I always say is, so there's a process. Okay, you want to get them into the frame of mind of signing contracts, because that is how you will test whether they're serious about a transaction or not. So where does that start? You start with an NDA. Okay, NDA, level of protection, not that high, but you want to get them into the frame of mind of signing documents. So start with an NDA. Even with an NDA, you actually want to phase your information release. So every stage essentially should have a specific system of what information you're releasing. Once you have given them an NDA, then you want to start to give them maybe some more protected documents, but you still don't want to, reveal the entirety of, what you have to offer just because there is an NDA. You still want to essentially always be moving them towards the next milestone. So once there's an NDA, then you need to give them as little as possible to get them to actually put a valuation on paper in the form of a term sheet. Yeah. And in that term sheet, there's a clause that you can put in there that's called a breakup fee. A breakup fee essentially says, hey, we're going to contemplate this transaction, but if you terminate the transaction, you have to pay me for my time, you have to pay me for my lawyers, you have to essentially compensate me for the time that I've spent on this transaction. The seller's job in any transaction is to be pushing the other side gently, not forcefully, but gently, to essentially pony up. Hey, if you're serious, I need to see that we're actually going to do this deal. Let's get into an actual contract. So it's okay, you've signed the NDA. You want to, for example, see our back-end infrastructure. Okay, we'll provide like a high level, outline of how our back-end infrastructure works. Okay, so how does the buyer respond to that? Buyer is going to respond to that. We want to meet the entire technical team. We actually want to do a code review. Well, I'm actually really trying to get an understanding of, what is it that the seller should also always be doing due diligence on the buyer in terms of why do they want to buy, who have they bought, how much money is essentially in the fund, how are they valuing the companies, what is their process, what does the buyer's imagined process look like of acquiring companies? How long is your timeline? Okay, your timeline is 2 months. Well, tell me, in that 2 months, how much time are you going to spend before you issue the term sheet? How much time are you going to spend on due diligence? How much time are you going to spend on the purchase agreement? What you're essentially doing is you're making the buyer give you a structure that if they fall outside of that structure, something is not going as according to plan. Yeah. So these are the ways that you can essentially protect yourself.
This is great. I feel like what you're doing there is getting them to put some skin in the game and show they're serious. And if they're just in it to in and out get information, you're luring them in and show me you're serious, show me you have skin in the game. And I can see how that probably weeds out a lot of people, a lot of potential buyers. What about the clause? I love the was it called the breakup clause? I love
breakup
that
fee,
one.
yeah.
Breakup fee. What if they're like, well, we're happy to agree to this, but as long, we'll only pay a fee if we see something wrong with you. I don't know, we didn't like your data or whatever, or you don't have a mode or whatever. I assume there's some pushback on that, or have you seen them, or have you seen that go through more often than not?
Well, I think even in that instance where they're like, oh, we'll only pay the breakup fee if there's no issues with the company, is like, listen, every company has issues that are going to come up. We're not a perfectly run business. I just want to make sure that the time that we spend on this transaction is actually moving towards the intended goal of the transaction. So what do you need to understand about my company so that we can proceed and move forward with the understanding that there is an actual contemplated transaction here? And that, again, even their rejection of the breakup fee it's another trail to a really important conversation.
Yeah. It's a data point. Yeah. Super cool. Oh my gosh, I have so many questions. Alex, I know we're at time. We should probably wrap up soon. I do have one more question for you. So for me, when people ask me, why are you good at negotiations? I say a couple of things. Well, I was trained at MIT. I have a passion for behavioral sciences. I've been doing this for a while. And then
you also come from a country
exactly. That was going to be a very key
go-getters.
Which is, I'm an immigrant in the U.S. from Albania. We have a bazaar too. We call it pazar, so it's very similar. And the hustle mindset, both in a developing country that was war-torn as I was growing up and coming into the U.S. And when you said that your dad brought negotiations into the U.S., I was thinking when I went to a very high-end store and I was negotiating the price of sunglasses, they had never...
They're like, what is this person doing?
And I managed to get a solid discount because I was like, is there anything you can do? They're like, I guess I can give you my employee discount. But anyway, I was curious to hear, and we touched on this a little bit, but what makes you a strong negotiator?
I always tell people it's my interest in humans. It's my curiosity in humans. And you know where it actually started for me was very random. I went to couples therapy many years ago. I went to couples therapy and I learned something called the imago dialogue. The imago dialogue is essentially, it's a mirroring. It's I heard you say, and so it's a restating of what you heard the other person say, and then it's an identification of what they must be feeling based on what they said. And when I started thinking about human relations in that way, it inspired so much curiosity for me. And so I bring that curiosity to my negotiations in terms of, okay, what is this person thinking? What is this person feeling? What is influencing what they might be thinking or feeling? And it just absolutely fascinates me. So I think, yeah, if I had to say anything that makes me a strong negotiator, it would be that.
So your clients are right. You are an overpriced therapist, basically.
Yes, absolutely. That is absolutely true. Yes. But I'm like a therapist with sharp teeth, essentially. So
not overly validating. No, we have to. I love that. Thank you for sharing that. Any final thoughts? Anything we haven't asked you about that you want to share?
No, this has been a great conversation. I really appreciate the opportunity to share.
Awesome. And how can our listeners learn more about you?
Or engage with you?
Yeah, so LinkedIn, if they search my name, I'm super easy to find. People say that if they just Google my first name, a ton of Google results will come up. So it's not difficult to find me. But Omeed Tabiei on LinkedIn, SaaS Biz Lawyer on Instagram. Those are two of the easiest ways to find me.
Okay, great. Yeah, we'll make sure to include links for people to find you in the show notes.
Yeah.
But I'm so glad we randomly DM'd on LinkedIn a week ago, Omeed, and now we had this conversation. Yeah, really appreciate your time. Thanks so much for joining us on Gentle Power.
And would love to meet in person. We co-work in the Ferry Building, so would love to have you there sometime.
I'll see you guys there.
Okay.
Awesome, cool.
Bye.
Yeah, thank you.